Joining us now is Matthew Bartolini, head of ETF research for State Street Global Advisors. Well, a lot to talk about today. First, how should ETF investors be thinking about the U.S. market entering bear market territory, and what kind of trends are you seeing in the ETF space?
Well, I think it's also helpful just to remind everyone that, market sell-offs do happen, volatility does occur, and that the old adage of time in the market is better than timing the market. I mean, basically the probability of losing money on a single day in the S&P 500 going back to the 1920s is about 46%. But when you start to extend that time horizon, it gets lesser and lesser. So basically over a 3-year period, you basically only have losses in roughly about 20% of the time going back over the last 100 years. So having a longer view can be really helpful when you have significant volatility going on in the markets, and that can be unnerving. I mean, the term bear market is actually not a really great term to hear. That can create a lot of turmoil inside and start looking at your portfolios and readjusting. So we always try to caution about making knee-jerk reactions to market environments, because again, time in the market is better than timing the market. But we do see some investors start to rotate portfolios and adjust based on market conditions. And so far in April, what we have seen is basically a natural de-risking, going into exposures that basically have positive relationships to falling growth and rising inflation. So we've seen inflows into gold, into commodities, into inflation-linked bonds, as well as into broad-based treasuries. That's where we've seen the more tactical shifts, and then away from, say, U.S. sectors, where you've had a natural de-risking of outflows as well.
Yeah, building off of that, what kind of buying behavior do we typically see during market sell-offs, and how does this sell-off compare?
Well, this sell-off is quite swift. If we go back to, over the last 100 years and we look at how quickly markets have moved into bear market territory, this is now the second fastest on record, only behind the COVID pandemic and just ahead of basically the 1987 crash, which was quite fear-inducing as well and also quite rapid. Now, the buying behavior or just overall motivations from trading that we have seen is that we have seen investors express some views in the market. So we look at ETF trading volumes. We look at just the Spider ETF trading volumes. It hit a record high on Friday, greater than the record that we set in 2020 during the onset of the pandemic. So there has been capital being deployed either to seek out mispricings where there's now more relative value opportunities, or just to de-risk. As I was mentioning earlier, we have seen outflows in some of the more risk-on strategies like sectors and industries. But I think when we think and take a big step back about what buying behavior should look like, it should be sticking to your plan, sticking to that long-term asset allocation mix, making sure you're diversified. It is far easier to prepare for different economic environments than it is to predict those. I think we're starting to see that now because we were only at record highs just 2 months ago. And I don't think anyone would have predicted a 20% sell-off in a matter of, say, 3 days.
And when it comes to staying the course and sticking to those long-term goals, one way to do that can be constructing a resilient portfolio. How should investors be thinking about portfolio construction?
Well, I think what we have seen leading up to this is that a lot of investors were not really that diversified. In fact, they were probably very concentrated. Even the 60/40 portfolio, while it gives this auspice of diversification, you're very equity sensitivity. You're inheriting the boom bust profile of equities because equities basically are driving 91% of your overall risk budget. Now, what we have seen from flows in the ETF industry leading up to that is a significant allocation into US equities. So a lot of the buying behavior ahead of this sell-off was into leaning into that concentration of a portfolio. We're not sufficiently diversified. What I think was interesting is that, in 2024, you had muted inflows into things that have a positive reaction function to rising inflation and falling growth. Inflation-linked bonds had outflows. You had gold, which had a mixture of inflows and outflows and fits and starts. So investors really weren't being fulsomely diversified across different economic environments. And then in 2025, we started to see that build up just a little bit more. If we look at really inflation-sensitive asset allocation sectors, so inflation-linked bonds, broad commodities, and gold, you take those together, the rolling 3-month flows into those assets actually hit a high not seen since COVID. So you start to see a little buildup of more diversification, not just between assets, but between economic environments like falling growth and rising inflation.
And this also goes without saying, but one way to diversify is by investing in ETFs versus, say, single name stocks.
Oh, of course. I mean, diversification is sort of the only free lunch out there. And if you're buying single stocks, you're now just incorporating a massive amount of single stock risk. So, using broad based macroeconomic exposures to diversify your underlying holdings beyond just one or a group of seven magnificent stocks can be helpful because what we're seeing now is some stocks that maybe had high valuations and had that elevated amount of growth priced into that high valuations are now being re-rated quite significantly so. So diversification can help ameliorate any of those sort of concentration risks when some single stocks are being more impacted punitively as a result of macro forces like tariffs because perhaps they operate very much outside the US. Whereas maybe owning something that is more defensive and domestically oriented to offset that could be helpful. And that's why we're seeing things like healthcare services, utility stocks, insurance stocks, which are more service based and more domestic, actually have inflows, but also do better on a price perspective versus, say, just large US cap, mega cap tech.
Well, a lot to talk about. Thank you so much for joining us today, Matthew.
Thank you.
And thank you to everyone watching. Once again, that was Matthew Bartolini, head of ETF research for State Street Global Advisors. And I'm your host, Jenna Dagenhart with Asset TV.